Are you thinking about buying a house? One of the big steps in homeownership is understanding your mortgage payments. But don't worry, it's not as complicated as it sounds. Let's break it down together, step by step, in a simple and clear way. Before we dive in, be sure to check out our previous video on effective annual interest rates. It's a great foundation to help you understand this topic more deeply. When you take out a mortgage, you'll make regular payments. These could be monthly, bi-weekly, or even weekly, depending on the payment schedule you choose. Each payment is divided into two parts. Principal, this reduces your loan balance. Interest, this is the cost of borrowing money paid to the lender. Your payment amount depends on three key factors: the mortgage amount, how much you borrow; the amortization period, how long you'll take to pay it off; the interest rate, the cost of borrowing. Whether you pay monthly, bi-weekly, or weekly, these factors remain the same. Only the frequency of your payments changes, which can affect how quickly you pay off your mortgage and the total interest paid. Imagine you borrow $25,000 to be repaid over 5 months at a 12% annual interest rate compounded monthly. Since the compounding period and payment frequency are the same, the monthly interest rate is 12% divided by 12 equals 1%. Here's how your first payment would look. You owe $25,000 plus $250 interest, 1% of $25,000. If your monthly payment is $5,151, you'll pay $250 in interest and $4,901 toward the principal. This reduces your loan balance to $20,099, so next month's interest will be lower. For your second payment, you pay $201 in interest and $4,950 in principal. You continue paying $5,151 every month until the end of the 5th month, when you'll have fully paid off the loan plus interest. Notice how, with every payment, your balance shrinks, and more of your payment goes toward principal instead of interest. Now, let's see how this works for a real house. Suppose you're buying a $500,000 house in the United States. You've saved $100,000 for a down payment. That means you'll need to borrow $400,000 from the bank. The bank offers you a 30-year loan at a 5% annual interest rate, compounded monthly. That's a loan term of 360 months, with a monthly interest rate of 5% divided by 12 equals 0.4166%. Using the mortgage payment formula, your monthly payment comes out to about $2,147. If all this math feels overwhelming, don't worry. There's no need to calculate manually. Just search for a mortgage payment calculator online, plug in your numbers, and voila, you'll get your monthly payment instantly. If you live in Canada, make sure the calculator uses semi-annual compounding, not monthly compounding like in the United States. For spreadsheet fans, you can use the PMT function in Excel to calculate it too. Enter the interest rate, aligned with your payment schedule, the number of payments and the loan amount as a negative number, and Excel will calculate your payment for you. And that's it. Understanding your mortgage payments is the first step towards smart home ownership. Here's what to remember. Your payment includes principal and interest. Over time, as your balance decreases, you'll pay less interest and more principal. If you have a variable rate mortgage, be prepared for rate changes to affect your monthly payment. In our next videos, we'll dive into other important factors to help you make informed decisions. And don't forget, you can use the Market House app to visualize the impact of key factors on your total return. Just input the details of the property you want to invest in, and the app will show you how your return evolves over time. If that sounds exciting, subscribe to our channel and join us for the next video. See you there!